let's bring in Neuberger Berman's John San Marco, who runs the Connected Consumer portfolio. John, welcome. These two companies, very different. Home Depot's got the whole commercial and construction arm of this, which reflects perhaps different things. What are you looking for in these reports?
Great. Thanks, John. Thanks for having me on. Yeah, very different setups. At Home Depot, they're actually coming out of probably a 2+ year period of home improvement recession, if you will. I mean, consumers spent all they could on their homes back when COVID first started, and then they've had to digest some of that. Demand expectations are quite low. They serve a very high-end consumer who's generally more resilient and sitting on a mountain of home equity. And so we see things getting better there, not necessarily in the first quarter, because the first quarter, may or may not have some hurt from weather and rates and consumer confidence. But we think we're nearing the bottom of that cycle, and we own a little bit of that in the active ETF that we manage. And then Walmart, on the other hand, I mean, they've been doing everything right. They've been in the right place at the right time. They're hitting on a number of new growth vectors, like an advertising business and a third-party marketplace business. Expectations are a little bit higher there, so we'll see how tomorrow goes. But just taking a step backwards, this is a business who has some new, promising, exciting opportunities, and,
right.
And the data we look at all suggest they're doing well on those fronts.
In a way, inflation has benefited Walmart, where it's hurt Home Depot, right? Because Home Depot, had items priced higher that helped their revenue. And then on the consumer side, when consumers have been hurt by higher priced items, you saw more of the middle class that might not have shopped as much as Walmart heading into those stores. So how do you expect the inflation setup to affect Walmart in particular?
I think that's well put. Not only does inflation drive some trade down into the Walmart store from perhaps less competitively priced retailers. They're also selling a product that has pretty inelastic demand. So they take the pricing up, and by and large, the consumer is going to continue to buy the same amount of toilet paper and batteries and cereal and so forth. So it's been a good guy that's becoming less of a good guy, and at this point, I think that's all pretty much rear view mirror, and I think inflation is sort of a non-factor looking forward for Walmart. Inflation's come in quite a bit. At Home Depot, to your question, I think the bigger issue is as inflation stays too hot. When it got too hot, interest rates spike, of course, and that has all sorts of suppressive pressure across the home improvement complex.
Speaking more on that, one thing that a lot of people tend to do to pay for home improvement projects is tap into their home equity, and that gets a lot more expensive with interest rates stubbornly high, right?
Exactly. Yeah, it makes it a little harder to move, so it slows down housing turnover, and that's a headwind for the business. Now, it has been a headwind, and we're at multi-decade lows, so I think incrementally we're likely in a better situation a year from now. And to your point, it also makes tapping into home equity no matter how much home equity it is, it makes it more costly and a little less appealing at the margin. But again, incrementally, I don't believe that home equity lines have been some huge tailwind for Home Depot that now they have to anniversary. Rather, expectations already sort of reflect this higher rate environment.